For those of you who don't know me, my name is Allison Harvey. I am the president of the Auburn Chamber of Commerce this year, and I'm really excited that we've been able to pull together a pretty fantastic seminar series, if I do say so myself. We've had, I think this is our third seminar so far. We're running them through our new Business Continuity and Recovery Committee. Our head of that committee is Steve Lease. It was his fantastic idea that we should have a Business Continuity and Recovery Committee to assist our businesses and our local community. One thing that we are really proud of is that we are opening these seminars and all of our resources up to all businesses in our community, not just chamber members, because we want to make sure that every business in our community is here when this is all over and we settle into our new normal. Richard Hall has been also an amazing resource. He is the chair of our Government Affairs Committee, and that's the official committee that Business Continuity and Recovery is under. And so I want to thank both Steve and Richard for all of their hard work. They have been putting in countless hours under both of those committees to make sure that resources are available, that these seminars are happening, and that we are able to help our business community. So thank you both, Richard and Steve. I really appreciate all your hard work. Today we have George Graziano, and he is a CPA. He is a CPA with Tax Planning Professionals, Inc. And I am really excited because today he's going to talk to us about some of those big tax changes that we've seen come through and heard about as a result of COVID-19 and how they might impact you, probably both as an individual and as a business owner. So I'm just going to pass it right on over to George.
Okay, thanks, Allison. So I'm going to present a kind of a slideshow as I talk, similar to the last one. And Richard, I just don't recall the protocol, or Allison, of when does, do I do that to take over the screen? Okay, hang on a second here. So
yeah, you can all you need to do is hit the share screen button and bring it up.
Okay, thank you.
Yep.
Okay. Wait, why is it doing that? Okay, wait a minute. Okay, hang on. And let me just change this and get this out of the way. Sorry. Okay. Okay, and I need to get this out of the way. Okay, so can everybody see that?
Yeah, looks good, thank you.
Okay, perfect, thank you. Okay, so that's just the title page. This is just a disclaimer. It just means, you know, all this is pretty new and kind of, you know, if you really want to know, you got to get your own advisor and figure out your own situation. A lot of it's fairly complex. And this is just for information purposes only. So this is a summary of what I'm going to talk about. So there were two recent tax law changes that went into effect both in March and in particular the CARES Act. I mean, most people know about the Paycheck Protection Program loan, which was the big component, but there's actually a lot of tax changes that are embedded in that particular law. Plus, kind of the forgotten sister, if you will, is the Secure Act, which came into be in December and was effective for 2020 and also has a lot of important stuff in it. So I'm really kind of combining all three of those and summarizing certain changes that were made in those three acts that to me seem the most impactful for people. And the topics I'm going to talk about are on screen there. So IRAs, retirement plans, and other tax deferred savings programs under one heading, some business provisions, in particular net operating losses and commercial real estate depreciation. And then a little bit on the employee retention credit and some other payroll tax matters. Okay, so that's the summary of today. Okay, a couple of quick public service announcements. IRA stimulus payments, this is, has been a very popular topic all over the news, and there's a lot of kind of hand-wringing and angst out there about these payments, and am I going to get mine, and when am I going to get it, and so forth. So this is, I'm not going to get into all of that. This is just a quick message about a part of the stimulus payments that isn't really talked about a lot, and I just think it's important to kind of tuck in the back of your head. So those stimulus payments are actually an advance payment of a 2020 tax credit. So if you're in one of the many categories of people who believe you are entitled to one of these payments, and you either didn't get it, or you did get one, but it's less than you thought you were entitled to, there is a mop-up process on your 2020 tax return where the actual credit you're entitled to will be calculated and compared to what you actually got. If you got more than the calculated amount, it's not taxable and you don't have to pay it back. So, that's a good thing to be aware of. If you got less than the calculated amount, you will get a tax credit on your 2020 tax return. That could either reduce your tax burden or be an additional refund at that time. So again, it's just one of the lesser discussed elements of the stimulus payments that I thought would be a good opportunity to share. The other one is this kind of delay that has benefited all of us for both 2019 and 2020 tax payments of not, no payments in April, no payments in June, don't have to pay anything for 2019 or 2020 until July 15th. Don't forget to pay. No one's going to remind you. Penalties and interest will start in earnest if you do not pay at that time. So if you're in that category, please set yourself a reminder to make sure you take advantage of that. Okay, on to the main program here. So IRAs, retirement plans, and other tax-deferred savings. So this area was impacted by all of those tax acts. And this, again, is a summary of not everything in those acts, but things that, again, to me seem the most impactful. So first one, 2019 contributions to IRAs, Roth IRAs, and health savings accounts are allowed up into 7/15/2020. So that's connected to those tax payment delays. That's quite a benefit for a lot of people. It gives more time to consider whether they want to do something like that, and raise the capital to do it if need be. RMDs. So RMDs are required minimum distributions. That's the, if you're over a certain age and you have to start taking distributions out of your retirement plan or your IRA, your 2020 RMD is suspended, so you do not have to take that. Again, that's a nice benefit if cash flow allows. For some people, that doesn't quite work because they need to be taking distributions out of that account. But if you're one of the lucky ones who has other resources and you can afford to delay that 2020 distribution, that's a great thing. It's really a helpful thing because as the market declined and people were having to take distributions out in a kind of a not very valuable asset, that's kind of a double whammy. So leaving it in there, allowing it to grow for another year is a good thing. If you've already taken your RMD, you can roll it over in a 60-day window. Normally RMDs are not eligible for rollover, but these are not RMDs. So if you did take one, it's not considered an RMD and you can roll that over. If it's beyond 60 days, so a lot of people take these in January, and the 60-day window may be already passed by the time this law was changed. Can you put it back? There's still some uncertainty to this. It seems like maybe this will be allowed, but from what I can see, it's still pretty uncertain. So if you're in that category, I would say keep talking to your tax advisor, keep talking to your plan administrator or investment advisors about that, and kind of stay tuned because that might work out. Okay, RMDs, again, staying on that topic, used to be 70.5. Then you'd have to start doing that. That has been changed to 72. So if you were due to turn 70.5 this year, you don't have to worry about RMDs until a couple years later. So that's a nice thing. That's a kind of a permanent change, not really related to the pandemic situation. Inherited IRAs. So it used to be you could stretch an IRA maybe depending on certain factors, or sometimes you were forced to take it out in a 5-year window. All of that goes away mostly, and you have 10 years to pay out. The schedule of when you take it within that 10-year window is entirely up to you. So if you want to and you can afford to, you can wait until the very last day of that 10-year window and take it then. There are some exceptions to the 10-year rule that still allow for lifetime distributions. I'm not going to get into those at this meeting. They're somewhat limited, but there are some in spousal IRAs where the spouse basically just steps into the IRA of the account owner is still out there. Okay, some continued stuff on IRAs and retirement plans. Okay, 2020 IRA and plan distributions. If you are below 59.5 and you took a distribution from your IRA or your retirement plan, normally that would carry a 10% penalty. There's some exceptions to that have been around for a long time. But if you didn't meet one of those, you were subject to a 10% penalty. For 2020 only, you can take up to $100,000 in such distributions with no penalty. There are some, there's an indication, that you are impacted, by the pandemic, but it seems pretty expansive of a definition, I think. And, to me, I think most people would fit, that definition. It is still taxable, as IRA and plan distributions always are, but the 60-day rollover period is extended to 3 years, which is really a remarkable thing. It's almost like in a way, like a loan you could take against, your IRA. So that's pretty interesting. The other piece of this, which kind of goes hand in hand, I guess, is the income from that distribution can be pulled into your tax return ratably over a 3-year period. So I'm just going to use 90,000 to make the math easier. So you pull out 90,000, 30,000 would be taxed this year, 30,000 next year, and 30,000 the following year. So this is somewhat of a confusing issue to me, in particular with this 3-year rollover, because what do you actually report on your 2020 tax return if you're in this situation? I took what would normally be a taxable IRA distribution, but I have up to 3 years to roll it over back into an IRA. What do I put on my return? It's not super clear right now, what that would look like. There are some other situations that we can look to in the past for similar types of things where there's almost like an open door, right? You're filing a tax return, which is supposed to be final, but there's something that's not final. And what do you do? So if you're in this situation, you might take advantage of extending your 2020 tax return out as far as you can to see, what happens and are you able to put some of the money back? Or you may have to amend a tax return to, to deal with this. So you might have to potentially pay tax on it in 2020. And then if you do, roll it over a couple of years later, amend your return and get the money back. This one's a little, the logistics of how this is going to work is a little challenging, right now, but, all these rules are really taxpayer friendly. And as certain things are getting clarified, they seem to continue to be focusing on, making taxpayer friendly clarifications. Okay, plan loans. the 50K limit is expanded to $100,000 that you can borrow from, say, a 401k plan, and there are some delayed repayment terms that might help if you have to do that. New plan, so if you're a business that's trying to start a retirement plan, there used to be a rule where you had to initiate it by the end of the year, or you couldn't get it for that year and you had to wait till the following year. They changed that, they cleaned that up in the end of 2019, where now you can create a retirement plan after the fact and have it kind of retroactive back to the prior year, which is helpful for business owners. 529 accounts, which are another sort of tax deferred savings vehicle. A couple of changes that came in this late 2019 that I thought were interesting. One is it can be used for apprenticeship programs now. So these accounts were initially designed for higher education costs. That's been expanded for some lower education, tuition and so forth, and has now been expanded for apprenticeship programs. The apprenticeship program has to be Department of Labor certified, but I just thought that was an interesting change. And also, I think a big change, which is really helpful to some people, is you can have a $10,000 repayment of student loans from your 529 plan. That's a lifetime number. And you can actually use it for siblings too. So if you have a kid that you have a 529 plan for, and maybe they don't have any student loans, but their brother has some student loans, that another 10,000 can be pulled from the account and paid for the student loans of a sibling. So that was pretty cool, I thought, of a change. So that kind of concludes the first part of this here for, again, the IRAs, retirement plans, and other tax-deferred savings vehicles. I'm just going to pause real quick, in particular, I guess, from Allison and Rich's perspective, if there's any immediate questions or anything I should go back over because it wasn't clear or something before I move on to the next topic.
We don't have any questions in the chat right now. So okay. Unless anybody has any questions, you want to speak up right now. You can just kind of raise your hand if you have a question. I'm looking at everyone right now. I'm not seeing anything. Okay. So why don't you just keep going on, and then for the remainder, if anybody has any questions, just throw them in the chat. You can either send them to me privately or put them to the whole group, and then at the end of the section, I can let you know, George.
Mm-hmm. Okay, great, thank you. Okay, moving on. Wrong screen. Okay. Okay, business provision. So net operating losses and commercial real estate depreciation. Okay, I'm going to start with net operating losses. So net operating losses have been changing quite a bit over the last several years. First in 2018, there was a pretty big change to them, which was kind of negative for taxpayers. So for the longest time, for the IRS, if you had a net operating loss from your business, you could carry it back 2 years and forward 20. That existed for a very long time. 2018, they changed that. They eliminated the carrybacks. So any losses could only roll forward. And when they rolled forward into the next year, they could only offset up to 80% of the income in that subsequent year. That was a pretty big change, and I shouldn't say all of it, most of it got kind of destroyed with the pandemic legislation. So new changes. So this is one of these changes, and the commercial real estate one is similar, where it's basically a retroactive change, where they're going back in time and opening up certain tax benefits, that may apply to you. So the new changes, if you had a net operating loss in either 2018, 2019, or 2020, those 3 years, those losses can be carried back 5 years and used to offset 100% of the income in those carryback years. If there's any remainder, or even through an election, you can, carry it forward to, either 2019 or 20, used against 100% of income. This may require you to amend previously filed 2018 or 2019 tax returns. But if you have a situation, where you had a loss in one of those 3 years, or you're going to have a loss in particular in 2020, but you had some big income years, in the past, this could be super helpful to go backwards in time and pull some of that tax money that you paid in earlier years, pull it into 2020 and 2021 and help kind of, reestablish your business or your finances. Okay, then going forward, and this is where it gets a little, it's a little confusing the way they have it written, but I'll try to make it as clear as I can. If there's any losses going forward beyond 2020, so maybe we carried some back and we used up what we could, and now we still have some left over that now have to travel to the future, and now we're using them, say, in 2021, there's kind of this dual path that's there. If the loss coming forward is from 2017 and earlier, can offset 100% of income. If it's 2018 and later, 80% of income. I really don't know why they made that distinction. It seems just more confusing than anything, but it is what it is. So again, that's not going to apply to everybody, but if it does apply to you, there could really be some significant tax benefits that you can capture, for you and your business. Last note here that, and this is really true, well, it's not completely true, but all the tax rules I'm presenting are really federal tax rules. California, of course, has their own tax rules. Sometimes California's rules sort of automatically comply and sort of conform to federal changes. Sometimes they don't. NOLs is one of those areas where really California has their own rules, and they don't necessarily follow, what the feds are doing. So, you just always have to look at California independently of the Fed and figure out what the rules are there. But, the feds are the big dog because, most people are paying a lot more taxes to the feds than they are to California. Okay, that's kind of it on net operating losses. Commercial real estate. So-called qualified improvement property. That's a specific kind of term of art that's embedded in the tax code surrounding this area. Really applies to any owner or tenant of commercial property who recently did or will be doing improvements to the interior of the building. So a couple of things to pause and note there. This is commercial property only. So if you're a landlord of, residential rentals, this does not apply to you. This is only for commercial property, and it really only covers the interior portions of the building. The shortcut on that is TIs. This is really kind of a TI sort of a, a benefit. So why are we here? Why are we even talking about this? Why do I perceive this as a big deal? So this problem or tax solution that was made in 2020 started as a problem in 2018. So the big tax law that was enacted in 2018 covered this area and really created this qualified improvement property definition, really from several other programs that were already running and were out there. So it kind of simplified it and intended it to make such costs and such assets of TIs and other improvements as 15-year assets, which means you could depreciate them over a 15-year life. That was the intention of the law in 2018. However, the law did not include any language to actually do so. It was just, it slipped through the cracks, so to speak. Congress was supposed to fix this in the intervening years, the 2019 and 2020, and they just never did. What that left us with was these costs are 39-year assets. So instead of getting to write off your TI is over 15 years, you have to write them off over 39 years, which is really a useless time frame, for most situations. And there's no bonus depreciation, which I'll talk about in a second. Okay, so new law makes it clear that these are 15-year assets. So we get our 15-year depreciation on these costs. That 15-year life is super significant because the feds also have a so-called bonus depreciation program where you can write certain assets off in the year that you incur the cost. So it's a 1-year write-off. The barrier for that ability is a 20-year life. So anything that's 20 years and below is qualified for bonus, and anything that's 20 years and above is not. So not only do you get 15-year write-off versus 39, you potentially, if it makes sense to you and if it fits with everything else in your return, you can take an immediate year 1 write-off for TIs and other commercial improvements to buildings. And it's retroactive back to 2018. So if you did a big TI program or other qualifying costs in 2018 or 2019 and didn't get to take advantage of some of this stuff because it just wasn't in the law, you can amend those returns now and recast those assets as with a shorter life and potentially bonus. Again, this is all federal. These are all federal rules. California has no such program whatsoever. So for the FTB, these types of costs have always been considered with a 39-year life. They still are today, and there is no such thing as bonus depreciation for the Franchise Tax Board. So this one, again, for those that it applies to, this is potentially a very, very significant change. And this change, it's not just 18, 19, and 20. It will carry forward now. It's kind of, part of the, so-called permanent tax law. So that one I thought was pretty awesome. Okay, so now I'm going to shift gears and move on to some payroll related stuff and payroll tax stuff. So for those who participated in the last presentation on some of these topics, I talked about several different payroll tax credits that were out there. The first two, which were sick leave wages and family leave wages, dovetailed into the Department of Labor rules that Allison talked about, that where it was expanded of sick leave pay and family leave pay, and there were tax credits connected to that. I think at this point, most people that it applies to are kind of fairly familiar with that. So I'm going to leave that one behind for this discussion and talk about the so-called employee retention credit a little bit. I also talked about this last time, but again, I think this one is, should be anyway, kind of more top of mind now. And this one will kind of run, really for the remainder of the year. And so it's potentially, again, a pretty significant benefit, if your company, kind of qualifies. So the big thing with this one is this is an either or with the Paycheck Protection Program loan. So if you applied for and received a PPP loan, you have the money in your bank, you cannot use this ERC program. So this could apply for, a lot of people, either didn't apply for the PPP loans or maybe applied and got denied, or more commonly kind of applied and got ghosted. I mean, just, never heard anything. The program has been kind of, fraught with challenges. And so a lot of people, just didn't get one of these loans, and maybe they won't. So if you're one of those, this is the path you should take. It is a, $5,000 credit per employee max. It's on wages between March 12th and the end of the year. So this runs for quite a while. And again, it is one of these things that, you know, if you're less than 100 employees, it's pretty easy to meet the qualifications for this. If you're more than 100 employees, it's a little more complicated. But again, it's one of these things, you know, that kind of is a catch-all. If you're impacted, you know, in some way, your company is, you probably can qualify for this. So you don't have to apply. There's no application period. There's no waiting period. You just, you know, through your kind of payroll process, you indicate certain wages that apply to this, and you know, the credits are kind of reduced against what payroll taxes you have to pay, and so forth. And so I just want to talk a little bit, that's probably enough on this one, I think, but I'm going to just talk a little bit about the credits and how they work, and then how you can maybe get the money in your hands if you don't want to wait for the credits to come to pass. So let's say for a particular payroll period, you run the numbers, you have a credit. The credit is offset against the payroll taxes you would have to pay to the IRS, you know, until they go to zero, right? So you could have a credit, say, of $5,000, and but you only owe, say, $2,000 in payroll tax costs for that pay period. The overflow credit rolls forward to the next pay period, will continue to offset payroll taxes in subsequent pay periods until it's used up. If the end of the quarter comes and it's time to file a 941, that is a place where there'll be, again, kind of a mop up, and any remaining credit can be refunded to you via the 941. If it's important for you to get that money in your hands before the 941 process cycles out, you know, the next 941 wouldn't be until July. If you need to get those credits in your hands prior to that, there's a brand new IRS form called 7200 that you would request advance payment of the credits. It's a pretty simple form, although again, there's been I think a lot of challenges with the program, in particular, people just filling the form out wrong, or maybe some fraudulent characters trying to get you know, some money out of the government for this. So anyway, again, this is a counter to the PPP loan process. If you didn't go down that road or it just didn't work out, you really should focus on this. Because again, if the max credit is $5,000, you know, per employee, depending on how many employees you have, that can be some significant money that can come your way or offset costs and so forth. Okay, last thing on payroll taxes, and really I think the last item for me to discuss today is payroll tax payment delay. Again, this is federal only. California really doesn't have a programmed delay for payment of their payroll taxes. You can request, I think, 60 days and get a waiver, you know, for penalties and interest, but it's a kind of a process you have to go through. With the feds, it's kind of automatic. You just do it, and you know, it will be allowed. So again, federal only. Again, this one, they made this one, I think, a little more complicated than it needed to be, but we'll kind of walk through it. So this is for employer Social Security taxes only. So does not apply to Social Security taxes withheld from your employees. Those have to be paid under the normal course. Does also not apply to Medicare taxes, either employee or employer. Those all have to be paid on a regular schedule. So it's for employer portion Social Security taxes only, and the Social Security tax portion of the self-employment tax that self-employed people will pay. Okay, so for those taxes that would have normally been due at any time between March 27th and December 31st, you can delay payment of those without penalty or interest. 50% of the delayed taxes have to be paid by the end of 2021, and the remaining 50% have to be paid by the end of 2022. It's basically kind of an interest-free loan that you can sort of take advantage of, to kind of help retain cash in your business. That's the idea of this. Self-employed individuals, they're a little different, obviously. They pay both the employee piece and the employer piece of Social Security taxes. So their delayed portion is 1/2 of their total Social Security tax. And that delayed portion, again, can be paid over this, 2-year of kind of window. Again, there is kind of a dovetail with the PPP loan process. If you do have a loan and your loan is forgiven, the delayed payroll tax sort of, the way it functions becomes more limited, and it shrinks the time frame you have to take advantage of the delay, and so forth. So, none of those, we're not there yet, because the kind of forgiveness process is really just kind of being, analyzed and considered now. But again, if you're going to take advantage of this and you have a PPP loan and it gets forgiven, you might want to revisit this and make sure you don't wind up in an inadvertent trap. I'll end this where I began it, with a public service announcement. So if you take advantage of this process, don't forget to make those payments for your payroll taxes. No one's really going to remind you, probably, and penalties and interest will start in earnest if you miss those dates. So that's kind of the sort of the hidden task with a lot of this stuff, where we're getting to pay things later. It's on us to remember to do that, and not wind up costing us money, when this was all designed to save us money in the long run. So I think that's it for me. I'm gonna stop the share and put it back to you guys. Okay, we're back. Okay.
All right, thank you, George. I think we do have some questions. I'll start with Catherine.
Sure.
One second, Catherine. I'm trying to unmute you.
I got it.
Good.
So I was talking with my banker yesterday because we just got approved and we're waiting to be funded. Mm-hmm. And when my partner and I were reading through all of the requirements and information, we thought that it was what you're talking about, from like the beginning of all, like from March 27th through now. But then when we were reading through it, it says from the date of funding, is when you can start counting the time that you can make payments to people. Can you speak to that at all?
Yeah, so the rules for the PPP loan forgiveness, I did not cover today. So there's nothing in my presentation that is about forgiveness of the PPP loan. That program has its own rules, and there is, once you get funded, the clock is running. You have 8 weeks to kind of meet the cost requirements, and the other rules revolved around that. So you're right about this. All the timeframes and everything I gave today are for these other programs that are specific to some of the tax credits and other things, but PPP has its own rules and own timeframes.
So I have a question for you. On
Sure.
The ERC, the Employee Retention Credit, it's my understanding that you cannot, I know you can't take it with the PP if you get PPP funding. Mm-hmm. It's also my understanding that you cannot try and claim ERC credit and family leave or sick leave credit for the same period of time. Is that correct?
Well, it's not necessarily the same period of time. It's the same wages. So you cannot use the same wages for multiple credits, but you can use multiple credits. You just have to make sure you're not double counting the wages.
Okay, so if the employee, let's say you maxed out the employee retention credit, they earned 10,000 in wages in a month and a half, let's say, and then you get the $5,000 credit for the first part of the quarter, and then the second part of the quarter you had to give them sick leave or family leave that would qualify for a credit there. You could use both within that same quarter.
Yep.
Okay.
Absolutely.
And then with the 941 filing, are those 941 filings, are there extensions there too? Are those filings not currently due, or are they still due by the end of, like, for first quarter this month, by the end of this month?
My understanding is they're still due on the same time frame.
Okay, and so I was looking at the 941s, and I know that ERC credit is applicable for the first quarter if there are qualified wages starting, I think it was March 15th, you said, and forward. But there's no credit line, and they say to roll them over to Q2. So would you just not pay the tax liability and then roll it over the credit to Q2? How do you handle that?
Yeah, that's a good question. Last I looked on that with this morning a little bit, it still seemed to say, at least what I looked at, but that doesn't mean it was the most recent. It would still kind of indicated that they're working on that, I guess. But so you might have more. That might be the answer, that it just rolls over and will be picked up on the second quarter. I don't necessarily have a better answer than yours on that.
Yeah, I didn't have an answer for that one either, so I didn't know what to tell people.
Yeah.
Question for George.
Yeah.
Hey, it's Keith Henschel. Thanks for doing this. This is really, really cool. Really cool. Real quick question on the IRAs. So if someone's already done their taxes and they do come up with some dough between now and July 15th, they just amend their taxes and put the money in the account?
Yeah. Mm-hmm.
Pretty simple.
Yep.
And there's no adjustment or changes on any of the income requirements establishing an IRA between how much money you were making. That hasn't changed though.
Yeah, not that I saw. I think all those rules are still unchanged. It was just a timing change.
Okay, thank you.
Well, thank you very much, George. We really appreciate your assistance. I will attempt to put this recording online. So those of you who had, found it to be beneficial and maybe have someone else that you'd like to share it with, you can probably, hopefully, as technology allows, find this on auburnchamber.net/COVID-19. That's our web page for anything related to COVID-19 and all of the seminars that we are doing. Again, George, I really appreciate all of your insight and assistance with this. The amount of knowledge that you have is very impressive, and I really appreciate you sharing it with us.
My pleasure.
Thank you all for coming today. Again, sign up for the next one, promote local business, and I look forward to seeing you all soon, virtually or in person. Bye, everyone. Have a good day.
Bye.